So we are very glad to have Ricardo Reis, who was due to talk in person when the conference took place, but we had to postpone this due to unforeseen circumstances. So we are glad to have it with everybody online. So Ricardo is very well known. I don't have to introduce him. He was professor at Columbia. Now he's professor at the London School of Economics. He's one of the most prominent monetary economists right now. And he's particularly adequate to tell us about something that has been neglected for decades during what was called the Great Moderation and following the period of relative disinflation after the 2008 crisis, which is the inflation risk. And now it looks like this risk no longer has to be neglected, and we are very eager to learn more about this issue. So Ricardo, the floor is yours, and you will talk for around 1 hour, and then we will have some discussion and questions.
Wonderful. Thank you so much, Gilles and Axel, for the invitation to participate in the original conference and to be here with you today to give this address. Let me, having started share my screen, let me put full screen, and let me ask for a thumbs up if you can see my screen. And so if that's working, okay, thank you so much. Great. So again, it's a pleasure to be here. I think the title of my talk says it all in terms of what is it that I'm going to be talking about. But let me start with the briefest of introductions to say that inflation is back. After 20 years or more, depending on where you live, where inflation has, to a first approximation, been essentially a non-issue. 2% plus white noise fit to the annual data of the last 20 plus years, 20 years in the Eurozone, 30 years in the US, fits remarkably well. And with the variance of that white noise not being all that large, has meant that inflation has been a relatively boring topic in the sense that, of course, monetary economists like myself and like many people here in the room may still find it fascinating and thinking about it, but it was certainly not one of the priorities in the people's minds and in public debates. Likewise, not only was not a priority, but this has reflected itself in how central banks have started more and more become worried or at least focused on issues like financial stability over the last decade, and or more recently, issues like inequality, climate change, and others, all of which are a reflection of the fact that inflation targeting central banks had been not having to do very much when it comes to inflation, or at least have been doing enough to keep it very well in control. Well, look now, and these are some pictures that I took, or some news from all from the same date, October 14th. I think this was 7 days ago, and I was revising the slides for this talk, and I just put on Google News inflation, and these were the top hits. The Financial Times was saying inflation is back and showing a supermarket with inflation associated with perhaps empty shelves. For Reuters instead, inflation is not the increase in the price of the goods in the supermarket, is somewhat have to do with what's going on with stock prices. Not sure how they got there. And perhaps more curious is that for the Wall Street Journal, fears of inflation are all to do with cheese and how much cheese is going to move and retail cheese prices are going to affect. Either way, either because you care about cheese, financial markets, or actually goods prices, inflation seems to be a concern among the public eye and certainly is discussed by the press. So what I want to discuss in this presentation, is go a little back a few months to discuss why inflation is back before I turn to the real question of where is inflation coming back in a more persistent way over the next 2 years, and on which, in the spirit of a keynote in what has been and what was a great academic conference, I'm going to, of course, separate that into 3 parts that are all based on 3 papers that I've recently written. Okay. So starting on looking back, Let me take you back 8 months to somewhere around January or even February or March to make a point that is, I emphasize, not Monday morning quarterbacking. And the reason why I emphasize that is that I am on the record, just go on YouTube at the macro annual panel as saying, I think, using either this exact slide or a very version of it 8 months ago. And that was to say that every theory of inflation that I know of, or at least every serious theory of inflation that I think is used by economists, predicted 8 months ago that 2020 would be 2021, the current year, would be a year of high inflation. Okay, why? Let's go over some of those theories. Especially for the students in the audience, hopefully you'll appreciate the refresher of your monetary economics theory. Dominant theory of inflation. Inflation is about the Phillips curve. That is, to understand inflation, think about what are output gaps, to what extent there is excess capacity or tight labor markets. Well, most estimates of Phillips curve say that it's not just the level, but also the acceleration, the change in that. And already back in January, February, March, it was clear that the economy was rebounding extremely fast, gaps were closing, and moreover, even on the shifts of the Phillips curve, expectations would be rising. And as a result, Phillips curves would say inflation is going to go up. And, notably, of course, Larry Summers was writing in the press, essentially almost entirely using this, let's say, theoretical apparatus in his head, saying inflation is going up. That inflation is going up. But even if you're not a Keynesian, if you want to use a name for those who often carry Phillips curves in their heads, but instead you think about inflation as being the result of interest rates, sometimes known as Vixelian theories, or if you want instead Taylor rules, as associated with the great economist John Taylor, then you think of, well, is the current interest rate high or low relative to a benchmark of what would be justified given the levels of inflation and, again, some measure of the output gap. Well, if you put any numbers into a Taylor rule of how the economy has been behaving over the last few months, you end with interest rates probably being somewhere in how you calibrate that Taylor rule between 1 and 3 or 4%. Interest rates are zero for the foreseeable future in a very aggressive way by central banks. Thus, you think inflation is going to increase. That's what those theories at their heart tell you. Third, if you're instead a monetarist and you look at things like at monetary aggregates, then you look at the data and what you see is that deposits in banks are at record high levels. A year ago, we sent a series of checks to people, a lot of fiscal support. Good thing that we did that, I think. But a consequence of that is that a lot of those checks went to a lot of people that didn't really need them to spend, to sustain their livelihood a year ago. And as a result, they saved them in banks, and deposits in banks have become very high. As soon as in 2021, it was clear, it was easily predictable that as soon as we reopen the economy with the progress in vaccination, people would start using those deposits to buy goods. And as a lot of money started chasing few goods, you would have an increase in inflation. Fourth, if instead you think that inflation is always and ultimately a fiscal phenomenon, in Tom Sargent's words, then what you have to note all the way at the start of the year is that we have record high public debt levels above already the levels that we had at the end of World War II, and very large public deficits with very aggressive governments in terms of their desire for reform on both sides of the Atlantic, and thus to think that fiscal dominance was at least a possibility, and therefore that inflation could only go up. Instead, you say, no, focus less on the process, focus more on the choices. Ultimately, inflation is about whether central banks are committed to their inflation target or not, and then they'll do whatever it takes, whichever of these tools to reach there. Well, in 2020, what did we have? A mission review at the Fed and the ECB, which are unambiguously been interpreted as putting more weight on output gap and other goals of the central bank beyond inflation, and therefore with less relative weight on inflation, thus more dovish central bank mandates, which will lead to a higher inflation, whether in a biased or in a systematic way. And finally, if instead in a long similar lines, you think of inflation as just something that the central bank chooses, exploring a Phillips curve trade-off, then you say that, well, insofar as this year, it was predictable that it was not aggregate demand, but I think supply and supply bottlenecks, there would be a constraint. Then we have standard theory of market shocks or supply shocks. The central bank will trade off having somewhat higher inflation in order to have a speedy recovery. Therefore, and I do not mean this that, oh, how bad we had inflation. Every theory predicted high inflation, and good thing that we had some high inflation. Maybe we do need more dovish central banks. That is the right thing to do with a supply bottleneck. A little more public debt as a result of the pandemic may have been the right thing. But unambiguously, we would have higher inflation. And lo and behold, theory was right. It's a good sign when, usually in economics, we have some theories say up, a couple of theories say no. We need to discuss why do we think we believe some, a few more than some others. That was not the case here. Sigh of relief. If inflation had not gone up, I would really have gone through an identity crisis in terms of what I teach my students here at the LAC, because I teach them versions of all these different theories. Good thing they went up. Bad thing for all the researchers listening to me. This experiment does not tell us what is the right theory of inflation, because every single one of them pointed in the same direction. And lo and behold, inflation went up, whether in the Euro or the United States. The question now, therefore, the question that should interest us as researchers or even as observers is this going to be permanent or not? An immediate answer that some people have given is, let's go and decompose inflation, the blue line here, into an absolute component, what I have called in my research with Mark Watson, a pure inflation measure, as opposed to relative price movements, which is what's here in the orange and the yellow line. Now, the history of inflation is that when you do this decomposition, and I refer you to that work on how we did that decomposition, is that you find that pure inflation has been, over the last 20 years, again, very stable, under control, and then most of inflation movements had to do with aggregate relative price factors, things like the relative price of investment goods versus consumer goods, durable versus non-durables, IT versus not. What's quite striking about the last year is that instead, a lot of inflation, the blue line is almost coincides in 2020 with the yellow line. These are idiosyncratic relative price factors. That is, the inflation mechanically has, in this mechanical sense, this is the composition, has been all about literally some goods that happen to go up a lot relative to other goods with no aggregate common factor behind them. That's important to note, but it's also important to note to say, so what? That doesn't invalidate any of these theories. None of these theories said that it would have to go entirely through pure inflation. Moreover, who said that relative things have to be transitory? There is an inheritance in monetary theory and macro history, a historical inheritance, which was the invention of the core inflation concept in 1973, which was when inflation shot up massively in the United States and elsewhere as a result of the oil price shocks. And policymakers at the time, facing the failure of their actions and their mandates as inflation shot to 10%, it reinvented the price index to look at and said, oh, no, don't look at that inflation. Look instead at core inflation, which takes out food and energy. And then inflation hadn't gone up quite as much in 1973 and 74, and then justify that by saying that, look, oil prices can only go up so much, and this effect is ultimately transitory. Therefore, it has become customary, and in my view, often a mistaken tradition, to look at core inflation as being more reliable on account of being the persistent as opposed to the transitory component of inflation. Not all this has very shaky statistical evidence in favor of this as a pure statistical question, but note that right away, even in the 70s, the relative prices, even if they accounted for most of the inflation in 1973, were not transitory at all. Indeed, they persisted for 7 years, insofar as transitory quickly becomes permanent. Yellow quickly through contagion shows up as gray or red, and so on. So this interesting for an accounting dynamics, interesting for us researchers, but to say what's going to go on, this does not in any way preclude one or the other. So the hard question I want to ask is this temporary? Are we losing the anchor? I will not keep you in anticipation of what I'm going to say, so I'll tell you right away my answer. it's still likely temporary, by which I mean more than 50% chance, but the anchor in the US is clearly drifting. The risk of high inflation has increased very significantly. I'm going to say a probability of something like 10% that we have an inflation disaster. The next 2 to 5 months are going to be absolutely decisive for the Federal Reserve to fix the mistakes it has made in the past 10 months. That the ECB has a few months as the advantage of time, not 2 to 5, but instead maybe 4 to 8 months, and it's been doing a little better. For us scientists, the variability, the policy mistakes of the last few months are good, but we are achieving a turning point and an important turning point. Okay, so let me tell you why I come to those conclusions based on some old-fashioned economic research. First, what do the market prices say? It has become customary, and I think a good custom, to look at this figure, which captures the 5-year expected inflation extracted from swap contracts. That is, what is expected inflation right now, say, between 2026 and 2031? Why? Because these are markets that are somewhat liquid, I mean, there are serious people trading in them, trying to both place bets as well as hedge their inflation exposure, namely on the side of pension funds. This, unlike surveys, has the virtue of revealed preference of people putting their money where their mouth is. And this series has turned out to have been somewhat informative since we've had these kind of data for 20 plus years. Now, if you look at this picture, you see that it has increased. I find it striking when I hear policymakers say, oh, it's just 2.2%. We're fine on this measure. Neglecting the fact that it's 2.2, 2.3% now, 100 basis points more than it was just 12 or 13 months ago. This is before the pandemic in January, February. That's a 1% increase on expected inflation 5 years from now on average over 5 years. That is a big shift in the anchor. Now, for the ECB, that's probably a welcome one, since the ECB had been running probably 100 basis points below where it should be. But this is a significant change. And moreover, remember that these pictures can always be scaled up and down by a hard to pin down risk premium. And so I find more informative their changes rather than their current level. And the changes are different. But still, to ask the question that I pose in the title, you want to ask, what is the probability of an inflation disaster between today and what is the tail? This is an average expectation. This is an expectation of the average outcome. What you want to ask instead is a probability as opposed to an expectation. That is to start by asking, what is the risk-adjusted probability, because this gives you risk-adjusted probabilities, of an inflation disaster between now and 10 years from now. Oh, I'm sorry, I made a mistake. This is not the 5-year, this is the 0 to 10. Sorry, I'm about to make that adjustment. But as experience has shown, we want to look perhaps to extract the more persistent component, not at the 0-10, but rather the 5 to 10. But the difficulty there is that it's very hard to measure that. That's a picture that hasn't really been produced by anyone. And finally, we want to go from the risk-adjusted probability to the actual probability of inflation disaster. In other words, we like to estimate what I called here with these Greek letters, the probability that inflation today in 5 years to 10 years is above on average some certain amount. And I want to show you some recent research that I have with Gilles and Alon Raviv on how to come up with these estimates. An obvious candidate is, let's look at inflation options data. And here is inflation options data around 2015 meaning the implicit probability density that you get from the Eurozone around 2013-15. Important, why? Because QE, this was around the time when the ECB started QE because of the shift to the left of the distribution. But let's look at the recent past, and in the recent past, what you see is a clear shift to the right, okay? Let's use the options, the swaptions and the put contracts in the inflation option market, as opposed to the swaps, to be able to focus on the right tail probabilities. I'm going to define a disaster as inflation being above 4% on average per year for 5 years. On the other hand, a deflation disaster, if we think about the concerns in the Eurozone back in 2015, is the probability of inflation being below 0% on average for 5 years. Given a 2% inflation target, these would be therefore a 10 log point deviation from target. So I think it's justified for me to call it disaster. I think even a very, very charitable and generous interpretation of a flexible average inflation target says that inflation was to average 4% or higher for 5 years in a row, you'd be missing your target. Okay? So that's what I want to measure, the probability of those. Why is not just staring here and at the mass under the red distribution for the US recently, or for the Eurozone 2015, the mass under the green distribution here, not give you the right answer? It does not give you the right answer for 3 separate reasons. The actual probabilities relate to the probabilities that you read off the options, literally the points in these figures, only once adjusted for 3 factors. What are those 3 factors? It is a real adjustment factor, it is a horizon factor, it is a risk factor. Or in other words, it is going from between 0 and 10 years to 5 to 10 years into actual probabilities and risk adjustments. And so let me, the 3 adjustments is, it turns out that the options probabilities are not even how should I say, meaningful risk neutral probabilities. We need to shift in probabilities that actually mean something. 1, we need to adjust for the horizon of 5 to 10 years, instead of neither 5 years nor 10, but 5. And we need to adjust for risk in going from risk neutral to actual probability. Let me tell you how we go about this when it starts by starting with what I meant by meaningful probabilities. Imagine a world in which there's 2 periods and 3 states, a disaster state for inflation, a normal inflation, and a deflation, if you want, or a moderate inflation state. Standard option price theory tells that the option prices are going to reveal to you the probability that we go from the normal state of the world in which we may be now to disaster, times the marginal utility in that disaster, times whatever inflation happens to be then. Okay? That is what the option price gives you. Okay? That is what an option price would give you. However, what is usually reported, say if you go to the Minneapolis Fed website right now, is simply the price of the option times the nominal interest rate. Why? Because the integral of the price of the options across all the states is the interest rate. So this is a number between 0 and 1, and therefore, as opposed to a price of probability. This is kind of standard why option prices, you can start with option prices, multiply by the interest rate, and come up with option probabilities. Problem is, what do these probabilities mean? The standard result that you will have learned in some finance class is that these option probabilities map into Arrow-Debreu prices. But what are Arrow-Debreu prices, which I'm going to call QD? They are not this number. An Arrow-Debreu price is the probability times the marginal utility times the real interest rate. It is not this expression. You therefore immediately see that if you start from the probabilities that your Bloomberg terminal spits out, you need to multiply them by this expression, inflation times the real interest rate divided by the nominal interest rate, in order to get actual Arrow-Debreu probabilities. Why? What's the intuition here? Why is this adjustment here? Why don't people usually make it? Thousands of people read Bloomberg terminals and read out ND. What are they missing? Why did it take to 2021 for us to make this seemingly obvious point? Well, the reason is that when you're trying to think about pricing an option on interest rates or on something else, as is customary, on equity prices, the fact that high inflation states are states where the value of €1 is worth less is second to third order. However, when you're thinking about an inflation option, you have to take into account, and that's what this term is really doing, that the states of the world in which the option is going to pay heavily when inflation is very high are also states of the world where the nominal payoff of that option is worth less in real terms. That is all that this adjustment is. There's this distortion of the probabilities on account of the value of money changing with the payoff of the option. Now, if all you're doing is calculating the probability of inflation being above, below 2%, its expected value, this term is approximately 1. In other words, inflation is approximately equal to its expected, therefore this adjusting for the value of money is not that important. But if you start thinking about the disaster values, i.e. you start looking at the tails away from the median of the distribution, then this starts becoming bigger and bigger. Indeed, it's a factor of 1.33 if you look at my case of an inflation disaster. Second issue, and so you have that adjustment can actually make quite a big difference. And this is how large the adjustment factor is. 1.3 on the inflation, 0.7-ish on the deflation. Second adjustment is the horizon. In the data, the 10-year probability is almost always above the 5-year probabilities when you look at the options. What does this tell you immediately? That inflation is a sluggish process. We think that if we're going to have a disaster, it's not going to be a disaster that lasts 2 years. It's going to be a disaster in the United States, in the Eurozone. It's going to be a disaster where for 2021, 22, 23, inflation starts creeping up to 3, 4, 5%, and then it stays there. And that's why the probability of disaster in the tail gets higher, okay, in the longer tail. It takes time to build up. As a result, when you look just at, say, the 10-year, you need to take into account that you're understating the probability, whether you look at the 10-year or the 5-year probability, because the 5 is bigger than either of those, because in the near future, it probably won't be as high. So what we do is we model this persistence carefully with a disaster plus local model by essentially using the fact that because we have options on both the 5 and the 10-year, they're implicitly revealing, just using the options data, now actual inflation data, what is the perceived persistence of those disasters with which to make those adjustments. And finally, thirdly, the third issue is, of course, risk aversion. Well, from the work of Robert Barrow with co-authors over the last decade, and especially recent work by Gordon Liao, we know that we need to adjust the probabilities for the fact that there's a variation in the stochastic discount factor, that there's risk premium. Well, using the same models of disasters as Barrow and Liao have used, that is, look at the tail events in which we have high inflation, look at whether those high inflation events are associated with how large historically, using the large data sets compiled both by Robert Barrow as well as by Moritz Schullerich, Alan Taylor, and co-authors, and adjust and making the pretty strong assumption that these follow a Pareto distribution such that having fit that Pareto distribution, this leads to a very fat tail in terms of inflation risk. We use a series of methods to come up with probabilities of an inflation disaster that are adjusted that stochastic factor. Okay, and when we do that, what that implies is that you can now make the same adjustments people have been doing to look at stock prices, do them for the inflation risk. Combine all three adjustments, and what is the result of doing these new techniques that we've developed? Okay. The first result is, that slide was redundant, sorry, is let me look at two key results that I already hinted at. As you may remember, or as I told you a little while ago, back in 2015-14, there was a fear of deflation in the Eurozone. That motivated QE, that motivated forward guidance, and in support of that fear, that motivated papers published in very good journals in economics, in finance, saying, here's all the policies, all the commitment we have to do to eliminate the fear of deflation, because that fear of deflation, even from options, is very high. However, the papers that had used options data to justify this, and that had deflation probabilities of 20, 30%, when you start from those and realize they were reporting what I call the ND probabilities, the option price probabilities, and you adjust for the fact that those are not our de Boer probabilities, and that's an adjustment factor I told you of 0.8. Secondly, you adjust for the persistence effect that I told you, which for the deflation cuts down another a 0.9, 0.8 factor. And thirdly, you adjust for the fact that in deflation times, you have a risk adjustment that says that because deflation has been associated in the last 120 years with recessions, and you have a risk adjustment factor that is about a factor of somewhere between, depending on which model of risk you use, 0.6 to 0.9, you end up with actually the risk of deflation was actually never all that big. It was never even higher than 10%. If we had been looking at the right options, it wouldn't have actually been that big. So that's revisionist economic history from 5 years ago when using the right adjustments. The second result, though, is the one relevant for this presentation, is that if you do this for the United States, the probability of a high inflation has been rising. My co-authors, we stopped this in April, but I can tell you, we're doing this with the August data. It is 13% right now. There is a very large increase in the thickness of the tails, much more than in the mean. That is, the markets are revealing a great fear of a true inflation disaster. Second part of the talk. So that's what the options say. The markets say, yes, there's an increase in expected inflation, but to me, much more relevant is they are really saying there's been a big increase in the probability of a disaster. It went from essentially 0%, subject to measurement error, 1%, to something like 13, 15%. Second, what do surveys say? And importantly, there is a perception often that people say, well, if you look at the surveys, even as the markets in the Eurozone were moving, as I was telling you, when you ask people, they're always super sluggish, okay? Surveys show almost no change throughout, even when inflation was probably somewhat de-anchored towards 1%. Aren't surveys always behind the curve? Should we not stop looking at surveys? Well, that is a very comfortable thing to say, certainly for a policymaker in the United States right now, because in the last 3 months, we have observed a gigantic jump in surveys. Expected inflation in the Michigan survey jumped by almost 3 percentage points in the last 6 months. I have spent far too much of my boring life looking at expectation surveys in the last 20 years, and this is really almost unprecedented. Okay, a 2% jump in the space of a few months in expected inflation. And even in the 5-year expectation, which is unbelievably sluggish, it's very hard to extract any information from it usually, you see quite a bit of an increase in the last few months. You have to really dig deep, as, I don't know, I've recently seen some perplexing working papers from the New York Fed coming out of New York Fed to say, oh, no. If you just happen to look at the 3.5-year survey, that one hasn't increased. Come on, look at the survey. Look at the one here, Michigan, New York Fed, whichever you want. This is a big jump when it comes to average inflation expectations, okay? More importantly, let's look deeper. And in my research, I have looked deeper starting many years ago by making the argument that we shouldn't just look at the average expectation, but we should be looking at the distribution, and in particular at disagreement, where disagreement when it comes to expectations data is measured not just by a standard deviation, but especially by skewness, because the distribution of inflation expectations tends to have this positive skew on account of there being people that systematically expect high inflation, perhaps as suggested by theory on the scars of learning, having lived through high inflation in the 1980s and those scars persisting for some time. What you see in that distribution is that the increase in the expected inflation started being very modest, because initially what happened, and this is why this is consistent with what I had shown earlier, which is a modest increase here in 2020 with the big increase in the tails, is that actually in the surveys you see something similar, which is in 2020, people started expecting a little bit more high inflation, but most of that was driven by a thickening of the right tail here in 2020, but not a big change in the left tail. Just some people start getting a little worried. And that's why the median type measures show almost nothing. What's very worrying is that when you look at the last 6 months instead, it is the left tail that has disappeared, it is the median that has shifted, and it is the thickness of the right tail that has really gone much higher. It is not just a fear at tail risk. In the surveys, you see more than the tail risk, you see a decisive shift to the right. In the Eurozone, the data is not as good insofar as you have to do this with professionals. This is my research showed this is much more revealing to look at this agreement and look at households, partly because the professionals, the samples are a little bit too small to measure second, third moments. But even there, you're starting to see a similar phenomenon of the median shifting with a thickening of the right tails. In Germany, you see this already quite clearly if you look at the last couple of months. Far still from what we see in the United States, but in time to repeat it. To be clear, I am not in any way arguing that this means that the people are always right, and if they're expecting high inflation, we're going to have high inflation. We know that beyond fundamentals, survey expectations are driven by what you may call biases. Namely, we know that, for instance, gas prices are very salient, or restaurant prices are very salient. And the last few months have seen quite remarkable idiosyncratic relative prices rising in those sectors. We know that people put too much weight on the last couple of months of data. They're backward looking in that sense. And so there may be an overreaction to that. And we know that people confuse relative and absolute prices. And the last few months with the relative price volatility we've seen is precisely a time for that to happen. Still, what's important is that even if you can explain why this shift has happened by non-fundamental factors, you cannot then dismiss these data because these expectations themselves, bias or not, feed into price and especially wage decisions by workers. And as a result, they feed into actual inflation. In fact, if we get to a point in which people are starting to ask for higher wages because they expect high inflation, by then what we know of wage price spirals is that by then it's too late. By then inflation is all but inevitable. Now, seeing the increase in the tail risk, seeing this shift in expectations, can we say, but there's something special and weird? The pandemic has been a very strange year in the last year. Can we dismiss these data as being some false positive, if you want, on account of all the distortion of the pandemic? And so a month ago, I presented the following paper at the Brookings meetings, where I said, why don't we go and look back at the last time when we had a clear inflation disaster happening in the United States history, and that was the 1970s. At the time, note that policymakers, as I put here in some of the quotes, even as inflation was growing, starting in 1965, 66, 67, arguably, policymakers kept on noting that, there's something going on in inflationary psychology, whatever they mean by that. There's a psychological environment that's driving this increase. Because there was always these appeals to inflation psychology, there was never any systematic measurement. If you want, expectations were treated as if they were a hat-on factor. Some appeal to some animal spirits to explain what was going on. What happens if you, and what I did in that Brookings paper was use some novel data that hadn't been used before of expectations in surveys to be able to measure distributions, and in particular disagreement measures, such as the ones I showed you for the last few months in the US. And what comes out of that that's somewhat worrying is how the late 1960s, the time when inflation was creeping up, looks similar to some of the things we're seeing now. Again, an initial thickening of the right tail that eventually leads to a hollowing out of the median and a shift of the expectations to the right. Moreover, if one looks at even, and that's why I started also with the speeches at the time, which are worryingly similar to some of the speeches that some policymakers are doing now to dismiss expectations data. It doesn't move. People are biased in their psychology, and so on. Likewise, you see in the 1960s that expected data, this data was dismissed because of stories of psychology and animal spirits, because of saying that, the data is always measurement, and persistently refused to acknowledge it. Okay? But let's look at history beyond just the United States by looking, instead of in time, looking across. Maybe the world was just different then. Let's look at other regions in the world in the more recent history. And that's what I did in this paper, the Brookings panel. And that's why I said, well, why don't we look at a famous case of an inflation anchor lost, Brazil to 2001 and 16, where we had an acceleration of inflation as a result of loose monetary policy and some fiscal dominance. Here is what these disagreement measures for households look, but perhaps more importantly, let's focus on what happened to the cross-sectional distribution then. At the time, household disagreement again revealed the same kind of pattern of right tail thickness eventually followed by a shift to the right, showed up in the cross-sectional distribution of household inflation expectations. That is, if you were looking at this picture, you would see, wow, in Brazil, this looked like what followed. If you look instead at Turkey in the last few years, again, you see a shift of distribution that is somewhat similar to what we have been observing recently. And moreover, you can use history to guard against false positives. In South Africa, a succession of really bad shocks, really unlucky shocks, having to do with its main trading partner in the euro crisis, as well as crops and problems in the energy market, very disintegrated South Africa, meant that inflation was elevated for a few years. Well, that elevated inflation, though, never translated into a shift in the expectations like the one we're seeing now. And lo and behold, when South Africa had a few lucky shocks, had gone the unbelievably bad run of unlucky shocks it got, inflation came straight back into the anchor. The data doesn't point to any drifting anchor, to no false positives. Moreover, if you want to look at the US in the other direction, note that in the more benign direction, when we had the other regime shift, the distributions, the disagreement again, pointed to it happening. Households were ahead of professionals once you look at second or third moments, now in the case of stabilization. Okay. Now, combining expectations, not nation, expectations data to infer fundamentals, let me tell you about a third paper that I've worked on over the last couple of years to try and see how can I measure this markets data, this household surveys data, to back out what's an ultimate expected inflation. And the way I've done so is by proposing the following model. This is the following empirical model. This is the expectation of inflation by a household age at time t. It is anchored by whatever is their prior, as in any model, but importantly, it deviates from that prior in two ways. First, household expectations are biased. They are biased in a way that I model with an exponential distribution, with a rival rate lambda, and that reflects ultimately the insights from the literature on biases from experience, on sticky information, on the fact that there's cohorts in the population that update slowly and remove their biases. Second or third, inflation expectations are partly, though, also driven not just by a household-specific bias, but also by household signals, EH, noisy signals, as in the large literature on noisy signals, going back all the way to Lucas Island, and more recently in the work of Marios Angelettos and a series of co-authors, that those noisy signals can drive the expectations and explain why we have such a large dispersion. And moreover, that households respond to those expectations, to those noisy signals, in an overreacting way, as in the work of Yurin Mar, Pedro Bordalo, and many co-authors, of explaining that overreaction based also in psychological models. This model leads to a cross-sectional distribution that will have positive skewness and a very large dispersion, just as we observe in the data. Markets then, market prices reflect adjustments for risk, the thing that I was talking about in the beginning of this talk, as well as the fact that markets have more information than households. And that information comes from the fact that market prices reflect also the classic Hayek-Grossman-Stiglitz, that market participants are using market prices to, in a fixed point, reflect the information from other market traders into the markets. While combined with not just the insights of Hayek, but the insights also of Grossman-Stiglitz, that there is noise, which I'm going to call here omega, drawn from a beta distribution, because in my model this has to live between 0 and 1. That means that you're going to have some noise, making sure that perfect revelation never happens. So market prices are going to reflect the fundamental expected inflation, but be deviated from it, the rational expectation of the amount if you want, but deviate from it because of risk adjustments and because of the noise induced by this market noise. Finally, professional surveys of traders will reveal to you a median, but then it's misleading because those are not the marginal traders and therefore are definitely very much affected by that same noise. The result of this is that taking this empirical model, which I've argued fits many of the theories and some of the features, the relevant features of the data, and fitting into this model the mean, second moment, and third moment from the household service distribution, fitting in the market price and feeding in the median professional from surveys of professionals, then the model outputs are going to be these key three parameters measuring the extent of bias, the extent of dispersion due to noisy signals, and the extent of reaction or overreaction of people, as well as what was the market noise and, crucially, the fundamental expected inflation pi. And so with this model, I can combine all the data I showed you in the first 30 minutes of this talk to come out with an estimate. The way that model works is if it observes that the market prices are really moving away from what we observe in the household surveys, it says this must be driven by the market noise, and therefore updates very little what happens to your fundamental expected inflation. On the other hand, if it observes a lot of disagreement emerging, it says that disagreement is emerging because some households and traders are catching up to reality in a way that the sluggish households don't, and therefore updates significantly what it says. This is not market noise, instead this is fundamental. Those discrepancies can be applied to explain what was going on in the 2010s, and here's particularly relevant the way in which there was indeed a potential slight de-anchoring on the negative side in the euro area, where in the euro area you see a de-anchoring that was happening around 2015-16, reflecting that towards lower than expected inflation. But importantly, these estimates also captured the de-anchoring of the 1960s, and in work that I can't quite show you yet for policy reasons, applying this model to the recent data, you see for the US the de-anchoring, but much less so or not yet for the Eurozone or the area. Fourth and final part of this talk, having shown you how all these data, how all the theories and all the expectations data were pointing to high inflation in the last 12 months, and especially to a fear of a tail of high inflation, let me end adequately with talking about policy. The biggest policy mistake your central bank can do, as two of my favorite economists, Christie and David Romer, wrote once, is the belief that monetary policy doesn't matter. That inflation is driven by base effects, statistical issues, that inflation is temporary, that it's due to supply bottlenecks. You may have heard many of these words being thrown around by central bankers in the last few months. This is dangerous. It is dangerous when central banks stop saying that if inflation is high, it's because of what they have done or not done, because inflation is a monetary phenomenon. There are headwinds or tailwinds, but the control of the monetary base and interest rates gives an overwhelming power to the central bank. Whenever central bank starts whining about how indices are mismeasured, this or that is driving discrepancies, bad luck means that inflation is going to deviate from target, the right answer is to say, you could do something about it and you could bring inflation down. What you should be telling me is why all these factors means that you don't want to do something about it, and maybe that's justified, as I think probably it was justified in the last few months about it. Still, when one looks at, in particular, the Federal Reserve and sees in the first 5 months not acknowledging the inflation rise by looking at selective indices of prices and talking about statistical measures, when one then looks at the last 5 months and it not acknowledging that the uptick in inflation expectations was clear and evident in the data, and when it looks at it talking a lot about transitory and underplaying the upside risks that I showed you are real, one does worry that the central banks are again falling prey to the most dangerous idea in their history. Most likely, as I showed you in this talk, it will be fine. Maybe a probability of, let me throw a number at you, 70% chance inflation is right now, given fundamentals, going to be transitory. It's going to come down in 6 months in 2022, and everything will be fine. But I already told you, there's somewhere like a 10% probability that we have an inflation disaster, that instead this transitory become permanent, then inflation with them swing from an anchoring. I would like to conclude this talk with the other 20% probability that I left out. If I said 70% that everything will be fine, 10% inflation disaster, 20% is it's not fine, but not an inflation disaster. What do I have in mind? I have in mind a central bank that continues to not acknowledge the risks, not look at the data, and as a result, falls behind the curve. As a result, has inflation accelerating in 2022 as a result of a couple of bad shocks, and then reaches December of 2022 and says, wow, inflation is really high. There's only so far we can start looking at select series of expectations, select indices, underplay the upside risk, and then steps on the brakes in a very abrupt way by raising interest rates by 200, 300 basis points. Why do I say this is a risk? Or why, and as a result, results in the 2023 recession as a result of a strong tightening in monetary policy. Why can I paint for you such a vivid picture? Because this is exactly what happened in 1969. The Federal Reserve, after spending 67 and 68 talking about psychology, temporary price indices, core inflation measures, and others, and doing nothing about the de-anchoring of inflation that you'd see then, stepped on the brakes very aggressively. For those the researchers in the audience, remember the Romer dates or the Romer shocks? Those series are driven by two very big events, Paul Volcker and December of 1968, a gigantic tightening of monetary policy that led to a recession in 1969 that I think economic historians would agree, or at least I would argue, was completely avoidable. And that on top of it, because it was so painful at the time, led to, as soon as there was a change in chairman of the Fed in January of 1970, with Arthur Burns taking over from Martin, immediately a reversal of that policy, such that not only we had a recession in 1969, but such a strong reversal afterwards that inflation accelerated. Inflation never actually ended up coming down decisively. So we ended up with the worst of worlds, which was a recession in 69 and high inflation still coming throughout the 1970s. The Eurozone is certainly not there yet, but it's not all that far from it. If the US is there now, as I was describing here, the Eurozone is not that far. What is becoming necessary? What is becoming necessary to my eyes over the next 2 to 4 months is, first of all, a reversal of asset purchases. I have here a picture of the Bank of England so that I don't just pick on too much on the Fed and somewhat on the ECB. Here is the pace of asset purchases since we started doing asset purchases, started doing QE. It doubled from before the pandemic to what it is now. If you think it was reasonable to double it from 445 billion to 195 billion because of how bad the pandemic is, then you have to come to the conclusion that the data says that it is no longer justified to be buying 900 billion pounds, a rate of 900 billion pounds a year of bonds. Because if you don't, then you must say that, given how good the data, the macroeconomy, how well or not badly the macroeconomy is doing now, then you must say that we did way too little in June. Okay? An intermediate step in removing some of the loose monetary policy to respond to my 30% probability that we end up doing it too late, to my 10% probability too late, 10% probability of a disaster, would be to start now removing some of QE. I find it hard to justify the pace of QE in the United States or even in the Bank of England or the ECB. Right now, the Bank of England is the first, and I put it here because I think it's the one doing the best by saying it will start reverting QE. Moreover, I think this would help quite significantly with the financial independence and the solvency of the central bank, because if higher interest rates indeed come with some probabilities I have discussed, the impact this will have on a very large balance sheet of the central bank and a very low duration of the debt would jeopardize that independent central bank. Likewise, together with reversing asset purchases, unconventionally conventional monetary policy. Let's go back to boring old central banking, where when you see a tail risk of an upside of inflation, you say, look, tell people, acknowledge that there's this big upside risk, say that it's still a tail risk, not an average scenario, reassure them that within your mandate, which remember, let's not forget, it's an inflation mandate, the ECB will do whatever it takes to preserve inflation at 2%, let me remind you that I can do something to stop it. Therefore, even if I don't increase interest rates now, and I don't think we should increase interest rates now, make sure that people know that you will do whatever it takes to prevent an inflation disaster. And with a little bit of luck, you can have a smooth landing, a temporary transitory inflation increase in 2023 that does not propagate beyond it. To conclude, is an inflation disaster around the corner? Most likely no. But that the probability is growing, the anchor is moving, and policymakers are being painfully slow to act in response. A critical point is in the near horizon. Starting to revert QE is, in my view, justified, as well as a restatement of the commitment to the inflation target, even though I am in no way saying that we should raise interest rates now. I absolutely think we shouldn't. I don't want to cause a 2022 recession, but I worry that we are heading towards a 2023 recession for no particular reason. A good example of the type of action that I mentioned here is, I think, the speech by Governor Waller just yesterday in the Fed, or even a speech by Isabel Schnabel a couple of weeks ago that I think is starting to hit exactly what should be done right now and consistent with this proposal. Lessons for economic science. 2020 in some ways validated our theories, but it also requires us now, as we look at 2022 and, sorry, this is wrong. 2021 validated our theories. 2022, 2023, though, requires us to go much deeper in understanding the unanchoring of this. But I hope to have shown you how the use of economic science to remind us of the past, economic history, bringing data to the debate, economic empirical work, as well as the use of equilibrium theories, can be useful to weed out bad ideas and to guide policy in facing these challenges. And with that, I hit, I think, exactly my 49 minutes. So I finished 1 minute early. And that is the end of what I had prepared. So happy to take questions now.
Thanks a lot, Ricardo, for this amazing talk. I can see people are raising hands, so I'm going to unmute Philippe first. I think you should be able to unmute.
Yes, hello, can you hear me?
Yes.
Okay, thanks a lot, Ricardo, for a very stimulating talk. There's a lot of material that is, of course, very interesting for macroeconomists working in a central bank and especially in the US. I wanted to say a few words. First of all, I mean, I think what you said in the conclusion is somehow consistent with the recent communication of the Fed, that is, starting to tapering asset purchases is something that they are considering, and it's not the time though to raise interest rates. So just to say that maybe there were mistakes before, but the conclusion that you made is, I think, relatively consistent with the recent communication of the FOMC members. And then I fully agree, and I very much like this paper by Romer and Romer, and this is a paper that I remember we used in several briefings while I was working at the Banque de France, around 2015 in particular. And I think that I fully agree with this view that the biggest mistake is to believe that monetary cannot do anything for inflation. But somehow, as you also rightly mentioned, more inflation and even some form of an upward shift in inflation expectation was something that was, desired by the change of the strategy, because the concern before the recent years was the opposite risk, that inflation expectations were too low, and they were lower than the pre-2008 level, and that was somehow one of the raison d'être of the new strategy, this flexible average inflation targeting strategy, and somehow you can say that there's a big risk that we're going to overshoot the target by, say, maybe 2% for 2 years, or maybe even more. but why would that risk be more important than missing the target for by, let's say, 1% for 10 years, or maybe if you consider Japan, missing the target for 30 years and be below the target for 30 years. Okay, so I think the key question, and I'm happy to have your view on this, is what is the inflation that you think the Fed can tolerate, and how can we think about this question right now?
Great, no, thanks a lot. I think we are in, like you said, and the way you said it, in some ways in agreement in terms of the facts, which is that, or in some of the points, which is that, is Fed policy right now moving in the right direction? Yes, and as I wrote in my slides, with a delay and fixing mistakes of the last 8 months. So you were more positive, I was more negative, looking at the mistakes that were done. But absolutely, and I finished by saying I pointed to the very last communication, the speech as of yesterday. So as the last communication, and I was saying, look, this matches precisely the slide that I had written. I had written that slide 4 weeks ago to present in Paris. I had no influence in what's going on at the Federal Reserve, as you well know, Philip, but you can believe how happy I was to see my slide showing up now in policy as of yesterday, as opposed to 4 weeks ago. So completely agree with that. One, but two, I've been a little disappointed over the last 10 months with the communication of the Fed. I'm not sure that Governor Waller is reflecting now the majority in the direction. That's certainly not the way in which it is seen. And I certainly haven't seen Chair Powell be as clear as, say, Chris Waller was last year in this commitment and in this message that I said. Number two, was the inflation of 2021 desirable? Absolutely, and let me emphasize that. And that's where I started, right? I said all theory predicted it, and I tried to make an effort. I hope that it wasn't missed, that not only theory predicted it, it was good, it was fine. Like I said, I think I said that the central bank being a little more dovish, accommodating the supply shock, the fact that it was a consequence of the fiscal expansion, of the acceleration recovery. In no way do I think that it would have been great that we kept our recession longer so that the Phillips curve would not affect it. So I could not agree more. I hope I said that 3 or 4 times. Thank you for giving me the opportunity to give it 2 more times now. Inflation this year being high is not just something that as a theorist, I was happy because it confirmed, again, it didn't force me to rewrite all my lecture notes. As a citizen, I'm very happy to have high inflation this year. I think it was absolutely the right policy from all kinds of perspectives. Okay, so absolutely agree on that. You asked though, Philippe, what's the right number? And I put that question somewhat differently. I put the question of what, in allowing for that high inflation this year, how long do I allow it for before I get worried? Or more, or perhaps more pointedly, given what I showed you, how much of a tail risk am I willing to tolerate? Okay. So whether it's 5 or 6% this year, frankly, I'm not sure if that's, or at least that's not the way that I would put the concern. I'm concerned with a central bank that moves too late, does not pay attention to expectations and credibility, and as a result has the shift of expectations we're seeing now not correct within the next 6 to 9 months. I'm worried about that tail probability, that 10%, growing to 20 or 25%. And these are 2 related concerns. So those are the concerns that I have. That's the sense in which I suggested a policy that, as you said, maybe is the policy that's being followed right now. Maybe not. I think people can interpret that. I think rather than ask the high inflation is, how do we make sure that that high inflation, let's be clear, it comes with a risk, and comes with a risk that with that jump up of inflation, because of the biases in the way people form expectations, because of whatever you want to blame it, comes with a risk that those expectations become ingrained, and we have a de-anchoring of the expectations, come with the risk that the actual inflation shoots up to a disaster, a tail risk. Those are the 2 numbers that I'm looking at. Those are the numbers that I was showing you. Expectations and the de-anchoring, tail probabilities. Those are the ones that I pay attention to. As of now, as I said in my conclusions, to me, those are tolerable, meaning I would not raise interest rates today or last month because I'm willing to tolerate a 10%, 13% tail risk. I'm willing to tolerate a little bit of the anchor of expectations for a few months. It's because I really don't want to jeopardize the recovery in 2022. But I am very wary of these risks. and I would like to see, and I would like to be assured in a way that not all speech of central bankers have assured me at all in the last few months, that they are considering those upticks. And as I said, I would like to see more old-fashioned conservative central banks saying how worried they are about the uptail risk and all the things they will do to stop it, even if that's not the median forecast. Thank you.
Thanks.
Dimitri, maybe? I think you should.
Yes, you're still muted, Dimitri. Okay, good.
Okay. Ricardo, great talk. Thanks a lot of food for thought. Very persuasive. So I cannot ask all the questions, but let me just ask one. And so you showed this graph where the expectations of inflation by this respondents of the Michigan survey went up considerably by about 2-something%. And so, of course, this is not the first time this happened. So like the previous time, it was probably before 2008 recession when it went up by about the same amount, but it was arrested by the global financial crisis. But there was another event in 2011 when it went up by about the same amount. But Fed didn't do anything and nothing followed. It just like it disappeared. So I just wanted to know what's your view on why it didn't create any de-anchoring that time.
Absolutely. That's a great question. Let's go back in time in history to 2009, 2010. Okay, I went through a few episodes, Dimitri threw another one. And so let's talk about how it fits into some of the things I was saying. Back in 2009-10, for those of you, I guess all of you were alive then. Oh yeah, I'm so used now to teaching young kids their LIC, but anyway, you all remember 2009, 2010. My students don't for some reason. We had, Dimitri, we had the push. Again, if you go back to theories of inflation, we had a very large push for a very large deflation, and we had it, a short-lived one. We had extreme monetary stimulus that pushed for very high inflation. We had some relative price volatility, nothing as big as we have now, but still some pretty dramatic ones, especially with movements in oil prices as is now. As a result, expectations shifted around. And in that sense, 2009-10 were indeed related to what we're seeing now, in that we saw some dangers of de-anchoring that. Okay, so absolutely correct that there are similarities now. What did we see then, Dimitri? That as there was a de-anchoring, a lot of the de-anchoring was towards the left tail, towards deflation by 2010-11. And what did the central bank do? Did the loosest monetary policy we had ever seen in terms of, as you know, rounds of QE, forward guidance, and whatnot. I would like to say, and consistent certainly with everything I've said in the last hour, that the central banks did very well then, stopped the deflation risk, and therefore led to the estimates that I showed you that meant that by 2012, 13, 14, that deflation risk had been conquered. But now, Dimitri, apply the reverse, and you would say, aha, therefore now, given the de-anchor that we're seeing on the other direction, we would want to have super tight monetary policy. I don't want to say that, Dimitri. And maybe you're saying, oh, Ricardo, but then you're cheating a little bit. Well, I don't want to say that because I think what's different in 2011 and 2020 is the other leg of monetary policy. In 2011, we wanted indeed to fight the fear of deflation, and we had the wonderful coincidence that comes with aggregate demand shocks that we also had too much unemployment and want to simulate real activity. And so that was the right policy. Right now, we don't have that luxury. Yes, if the economy, if the unemployment rate was absurdly low, if we were in a gigantic boom well above potential, then absolutely, I would be calling now for a dramatic tightening of monetary policy, because what I see in the expectations data and in the inflation data would combine with a big boom to justify tightening. But because right now we have the supply trade, the trade-off that comes with supply shocks of still being in a recession. Let's not forget, we're still in a recession. We're out of the recession in the NBR sense, but we're still below potential, although not for long. And at the same time, the inflation, I'm much more weary of saying let's tighten because of the inflation. And that's why I think let's tighten, yes, but slowly and gently, starting with QE, and maybe that will just be enough and we actually won't have to have any aggressive raising. So in a sense, that's how that fits. At least in my mind, I'm not committing any contradictions in terms of both what I said about policy at the end, as well as what the data shows. But maybe I'm being too generous to myself. That's okay.
Thanks. Manzi, do you want to ask your question?
Manzi, Oh, your audio isn't working because you're unmuted, but we can't hear you.
We cannot hear you, I'm sorry.
I don't know why. Something with your microphone.
So then let me ask a question then, and maybe you can fix your audio by then. Can I ask you, so you went back, you mentioned very often this 10 to 13% probability number, but you did not give us any sort of confidence interval on that. So for instance, how the way you model risk adjustment would change that? Is it like?
Yeah, no, great point. So, sorry, I need to remember what comes out of my paper. My co-authors are going to be mad at me. More like, I think the last number is 13% and the confidence band. I mean, well, it's a tough question to answer just because, you know, the first adjustment, Excel, there's no probabilities around it. It's just the right way to go to algebra. Yeah. The second adjustment, the one for the horizon, comes with an estimated Markov model and therefore comes with some risk bands. And the third adjustment comes with just the, if you want, the uncertainty about whether you're doing the right adjustment or not.
The last one would be the one that gives more.
Okay, so let's talk about the third. If you want, because I say we have not calculated confidence bands where, if you want, we bootstrap over these two sources of uncertainty in any significant way. On the third one, though, if you want to just focus on just risk adjustment, pure risk adjustment, what we have done is, and I had in the slides, probably very confusingly, 6 methods of doing this, which correspond, if you want, with what I think is more relevant than estimation uncertainty. Model uncertainty and how you model the risk premium, particular, how do you pick the probabilities of those disasters, the details, this is something that Dimitri has a fantastic paper in the AJ Macro some years ago with some co-authors on how to measure those disaster probabilities. There's different methods, different potential ways of doing it. Also, you add to that some risk aversion. Bottom line is, if that's the only one you want to know, depending on which one you pick, the number is somewhere between 8 and 16%. Still, the message that it's gone up, that it's completely unchanged. It's
went up and it is significant.
But this may be a failure of my research in that sense. That adjustment that I showed you, I don't have a way to estimate that at a high frequency and say the adjustment, the risk premium has changed in the last 10 months. And so it would always scale things up or down, but it would continue with the same qualitative one. Because again, I'm doing this adjustment using Sergeyev and company and others that do in their research, which is measure the probability using historical data to back out what those are. And that historical data is not particularly informative for the last 12 months.
Right. Thanks. Jean-Baptiste, let me unmute. And this will be the last question because we are running out of time. Jean-Baptiste, you should be able
Okay, yeah, sure. So thank you for this enlightening talk. I'd like to come back to the question that Philippe was asking, because you're very concerned about the right tail risk of having very high inflation. But what about the probability of getting back to the liquidity trap for a sustained amount of time? If we spend the next decade in the liquidity trap, maybe we would have missed an opportunity to de-anchor inflation expectations and to switch to a higher level. And maybe that's a risk, and that's what central bankers have in mind at the moment. And so, what's your view about the probability of missing this opportunity to get out of the liquidity trap for good? And how do you think about this risk?
That's a great point, by the way. That's a very good point insofar as, so let me first answer in terms of the estimates and what I've produced, just at least in the context of the models I've shown you. The probability of deflation is 0 now. Okay. It is really striking, by the way, because for the euro area, it was actually quite big 20 years ago, which is the point you're making. There was a probability of deflation that was around 8% in the euro area, according to my estimates, about pre-pandemic, which again is concerning. 8-10%, boy, we're going to may end up in a deflation spiral. And of course, you enlarge that to say, well, beyond deflation, I'm worried about liquidity trap. Forget just about deflation. I'm worried about 1% inflation. But anyway, let me stick with deflation, just because that one I've measured. And on that one has completely disappeared. That's a sense in which I didn't emphasize enough. I guess towards the end of my talk, I was a little bit too US focused. You could say as of April, and certainly as I was doing this research, my colleagues look at the numbers, I say, as of now, the ECB only has reasons to be happy because all we've done is killed the probability of deflation. We moved the expected average inflation back to 2, and the tail risk of the ECB is very small. So note that, I showed you the tail risk for the US. I didn't show you the one for the Eurozone. The one for the Eurozone is now much smaller. It's not my 13%. It's probably like 4. So I think as of at least August, you can still say at ECB, actually, it's been great. Okay. Let me, though, be curmudgeon worried, because that just follows naturally from my personality. You could say, absolutely, if the ECB now does the right policies and the right things and gets lucky, then this episode of high inflation has been great. The policy has been all completely adequate, and so be it. I'm a little more worried, Jean-Baptiste, only insofar as the ECB data in many ways has been very similar to the US with a 3-month delay in many regards. So I worry that in February, so that's why, remember in my first slide, I had the US as a turning point the next 2 to 6 months, the Euro area in 5 to 9 months. If the ECB does a phenomenal job, and I have no reason to expect it not to do a phenomenal job, it will be able to step on the brakes 3 months before the US does, in the sense that I described clearly. And as a result, we will have just de-anchored from the bad anchored. We have re-anchored where we should have been, and it will be a beautiful example of good sailing, if you want, in that regard. But maybe instead, it will drift up in the same way that the US has let it drift up in the last few months, to the point where I think we're at the border of what's tolerable, as in my answer to Philippe. So absolutely in that sense. Now, you add a little bit more, which is no, but beyond deflation, inflation, what are probability of liquidity trap? Obviously, the estimates that I showed you can't really answer that, because that's a joint probability of inflation with these other outcomes. But just to say, in that sense, that's a point well taken.
All right, thanks a lot, Ricardo. So we're gonna stop there. We are already like our time. Thank you so much.
Sorry, Nancy typed her questions in the chat.
Yeah, there's a question of Nancy that maybe we can. I don't know if Nancy is still there.
I mean, on central bank communication will play a big role. Absolutely. Note that what I was saying, whatever it takes, I even refer to whatever it takes, which is the fundamental, that is the golden rule of communication working and being the main tool. Remember, the ECB did nothing around there. I mean, OMT was never activated. It was 100% communication. You know, was that just good luck? Was it not? Can we ever emulate the incredible communication play by Mario Draghi? Who knows? And I certainly, being an observer of the communication literature, to which Philippe and many others have contributed, you know, I think our confidence that we can use communication only and get the exact outcome is still, I think, would be optimistic. But look, what I said, I think communication alone would be hard to pull it off, but I said a version of that. I said communication with unwinding QE is what I would do now, as an attempt to re-anchor things and make sure the right tail risk doesn't increase as much.
Thanks a lot.
Okay.
Thank you, everyone.
Oh, thank you all.
Bye.
Everyone.